Good evening, and welcome to tonight's market report. Let's start with the numbers. The Nasdaq closed at 26972, up 0.2%. The S&P 500 finished at 7580, a gain of 0.22%. The Dow Jones ended the session at 51032, up 0.72%. The VIX Volatility Index settled at 15.32. The 10-year Treasury yield stood at 4.45%. The dollar index came in at 98.91, while the offshore yuan was trading around 6.76 against the greenback. Bitcoin was at $73,883. WTI crude oil closed at $87.36 a barrel, and gold finished at $4,560 an ounce. Today we saw a fascinating divergence across global markets. U.S. stocks continued their rally to new highs, driven by AI tech stocks. The Nasdaq broke above 27,000 points for the first time ever. Snowflake shares surged more than 36%, and Dell Technologies jumped nearly 33% during the session, lifting the entire software and AI hardware sector. European stocks also rose, nearing record highs, helped by optimism over a potential US-Iran ceasefire agreement. But in China, it was a completely different story. The Shanghai Composite fell 0.73%. The Shenzhen Component dropped 1.81%. The Chi-Next Index lost 2.11%, and the Star 50 Index tumbled more than 5%. Money flowed out of high-flying tech stocks and rotated into defensive sectors like utilities, white liquor, retail, and real estate. So what is behind this divergence? First, the market seemed to shrug off the fact that the U.S. April PCE price index rose 3.8% year-over-year, the biggest increase in 3 years. Despite lingering inflation pressure, U.S. stocks digested the concern thanks to strong corporate earnings. On the flip side, China's A-share market ignored positive comments from Morgan Stanley and Standard Chartered about Chinese assets and the potential for foreign capital inflows. Those bullish calls did not help. Instead, the real drivers were the National Big Fund reducing its holdings in semiconductor stocks, combined with profit-taking after a long rally. Those internal factors dominated. Today we saw an important structural signal. Major funds flowed out of high-beta tech stocks and into lower-risk defensive sectors. Trading volume expanded, but most indices fell. This tells us money is not leaving the market. It is simply rotating internally. Northbound capital also bought into blue-chip heavyweight stocks, confirming the shift in direction. Looking ahead to tomorrow, the strength in U.S. stocks could lift sentiment in Japan, South Korea, and Hong Kong at the open. But for China's A-share market, the main theme will remain digesting the internal rotation and the pressure on tech stocks from yesterday's sell-off. In the near term, tech stocks may continue to face headwinds, though the pace of decline is likely to narrow. The key things to watch are any updates on the US-Iran ceasefire talks and comments from Fed officials on inflation and interest rates. These two variables will directly affect global risk appetite and capital flows. Overall, the market is undergoing a style shift. The sustainability of defensive sectors is worth tracking. And if quality tech stocks become oversold, they could present a buying opportunity. Stay cautious and keep a close eye on where the money is moving.